Okay, May 29th research meeting. Same disclaimer as usual. Just contact us today in regards to any security advice or any questions about anything discussed on the call if it is regarding a portfolio. I'll just be pretty brief this week. Looking at the S&P, they had a bit of a pullback, I'll call it, not really three-box pullback. It did break the resistance a couple weeks ago, but it's kind of stalled out here for the last 2 weeks. Support is 12 boxes lower, resistance up here about 7 boxes higher. It seems the tariff worries are slowly impacting markets a little less and less. They're kind of being priced in, we'll call it. Overbought, oversold 45%. It was an increase a week over week in the fifth straight week overbought. So technicals kind of all around improving. NASDAQ, same thing. 0 box increase. That's a typo for me, but created some new short-term support up there after reversing lower last week and then erasing that pullback this week. It is 1 box away from a third straight buy signal, which would be the first time that's happened since the fall. Overbought, oversold, 57%. That's an increase week over week. In the third straight week, it's been overbought by over 40% for the first time since December that's happened. So really seeing on the growth side, a lot of improvements when you talk about the technical picture. Looking at the Dow, 4 box increase. It did create a new sell signal at the end of last week with a bit of a pullback. That's the first since 3 straight in April. It did create new support, which is a positive sign before reversing earlier this week. Obviously, May's strong move has kind of boosted the overall US markets technicals. However, on the price target, it moved lower down to below 40,000. And then the overbought oversold slight increase week over week. And it's the fourth straight week it's been overbought. Looking at the TSX, 1 box increase to all-time high. You can see it broke out of this resistance. We've kind of broke out of resistance over the past, call it 3.5, 4 weeks. And now there's no more resistance overhead. So something to watch there for the Canadian equity market. Obviously, there's continued tariff optimism. The target price moved up higher once again to 1980. Overbought, oversold. That's the sixth straight week it's been overbought and the highest since December 6th. For the Canadian market at least, excuse me, technical picture looks the strongest on a relative basis compared to the US market. The VIX, we obviously got a bit of a pullback. The target kind of remains the same, still remains slightly elevated, but moving closer to that 15% range that we haven't seen in, I think, going back to February. It's important to note there that it increase in implied volatility kind of subsiding for now. Two bullish percentage charts not moving this week, both continue to increase and sitting, well, the S&P sitting in a bullish territory line, NYSE continue to move higher. Percent positive trend charts, the NASDAQ just about to break into that bullish territory area. It's at the highest point since it was at since the election, so something to note there for tech stocks. And then the Dow still has some relative upside compared to the last cycle, we'll call it on that chart. Looking at these two charts, really fast reversals over the last month for both of these. As I said, the Canadian equity picture continues to improve. It seems stability and a number of other reasons, including valuations, are attracting some investors. Listened to a piece on Europe yesterday. Obviously, there's some quality names in Europe, but there's also a lot of quality names north of the border that trade at much lower prices compared to U.S. equities. Just looking here, not a lot of changes this week, so I won't take much time on this, but precious metals jumped into the first position in commodities for the first time in a month. I know precious metals have gone on a run, but this just doesn't take into account gold. It takes into account silver funds, and platinum broke out over the last week to a annual high, so something of note there. And then within the sectors, basic materials picked up 12 buy signals to move up pretty heavily, something to of note, whereas technology has actually now slowed its ascension over the last month, losing 10 buy signals this week. Not a lot of changes, but a couple changes in a few sectors. Maybe that'll change after NVIDIA's earnings. Was it last night with the overall tech sector in terms of number of buy signals. Just looking here, this is the US 30-year yield, obviously all the way out on the yield curve. Just broke out to That's 5, so it's 50/50. That's 5.05%. That's the highest it's been at since October of 23. You can see it's only one box away from that high, as it seems for now. The Trump governments and the Fed are in an environment where they're obviously not controlling rates as much as they'd hope, and it seems investors are the ones who are selling bonds and pushing yields a little higher here. So another reason we weren't all in on the bond market yet this year. And speaking of, this is TLT. You can see it's pullback we've seen this year. Scores at almost one of the lowest scores you can have at 0.52 out of 6, obviously. This TLT is obviously the 20 plus year bond treasury ETF for the US. But year to date, it's down almost 3%, 3.5%. Last year, it's down about 5%. This move seems larger than it actually is, but you can see since that April high, it's down much more than that. Over the last month, it's down by more than 6 to 7%. Obviously, the investors with balanced portfolios continuing to slightly struggle, obviously, if they just are holding traditional bond funds and they don't have a long time horizon. Looking here, this is just the share of household wealth held by the Americans 70 years and up. Obviously hit an all-time high last quarter, but almost 32%. Obviously, we know this is an ongoing theme in the developed world. Some Asian countries, specifically South Korea and Japan, seeing their populations continue to age. Canada is going to continue to see it. Some of Europe will see it. The US will see it. And why do I bring that up? Just looking at some of these not beaten up, but companies that have pulled back home care and outpatient stocks. This is DaVita, scores at a 3 out of 5. Obviously, there'll be an increase in demand for some of these services, especially with some of that generation that continues to age, but some of that generation prefer to be in there. I know, speaking from a personal level, my grandparents and their friends, quite up there in age, over 90 years old, 92 to 3, all the way up to 96, but they really don't want to move out of the homes they've owned for decades. They obviously are utilizing some of these home care services. So just an idea there, after the pullback we've seen this year by about 26, 27% from the all-time high. Of note, only trades at about 11 times forward earnings. And then just here, looking at gold, obviously a bit of a seesaw over the last month and a half, 2 months, but nonetheless, still the technical setup looks great. It has about a $3,800 target. It's up 25% year to date. I mean, the miners are free cash flow positive, obviously. They got these large, juicy margins right now. And then there was a Florida bill that was passed where gold and silver can be considered legal tender, I think, where they're outlining how you can actually purchase goods in the future in gold and silver. So you're seeing continued use cases for gold, silver, and even Bitcoin. Obviously, there's still a lot of inflation fears, so we'll continue to watch that. And then just here, this is silver, obviously, which has lagged gold, and we're investors in some silver products, including some miners and some physical. We think there will be a catch up here. We just need to see a breakout out of this resistance zone that's highlighted by Dorsey Wright. But yeah, and then this is just the last chart. We own this in our relative strength platform, but just highlighting the strength of the obviously sleepy consumer staples sector. Scores almost 6 out of 6, price target 55, which is a little lower than the price today, but you can see that consistent increase that we've seen even dating back to the start of 2024, the last 2 years, really strong returns. And this ETF on a weighted average basis, still a decent valuation. It's up about 12% year to date, obviously outperforming the market, but when you compare that to the US market, really strong returns. And I think that's it for me.
So I think the big development that we noted is last week, the 30-year bond reached a new high going back to 2007 at 5.149%. And this is in contrast to the shorter end of the yield curve, which is not making new highs. And what that essentially means is that investors are saying, look, if you want me to lock up my money for 30 years, you're going to have to give me a lot more for it than if it's a shorter term. So what we're seeing here is what we've been talking about for some time, which is inflation expectations over the longer term are starting to really continue to rise, right? And so what we did is we wanted to take a look at why this is happening. So the next slide, we can see U.S. public debt. This is a chart that I'm sure many of you are familiar with. This is the near parabolic rise in U.S. public debt. The one that I'm sure most of you are also familiar with is the next slide, which is the outstanding the interest payments. And you can see that post-COVID and also post the increase in interest rates, we've seen interest payments nearly double from pre-2020. So what we have here is a situation where not only is the amount of outstanding debt in the U.S. High and rising parabolically, but it's also the interest payments themselves are also rising. I don't know if you would describe this as a parabolic chart, but it's really spiked up a lot in the last little while. Now, if we go to the next slide, what we can see here is we're just taking a look at effectively the profile of the debt. And so we have bills, notes, and bonds. And what you can see there is that bills are the ones that have really started to increase in terms of the average interest rate. Bills are short term, and so it makes sense that you would have a big increase in there for the short term. Now, when it comes to the U.S., what's really important, if we can go to the next slide maybe, is what is the composition? So bills are short term, notes are medium, bonds are longer. 32% of all outstanding U.S. debt matures in the next 12 months. So obviously bills are going to be included in that. But if we go to the next slide, what we can see is that bills represent 21% of debt outstanding, right? So what that means is that all the bills are going to come due in the next 12 months, but then also some bonds and some notes are going to come due, and they're going to have to be they're going to have to be rolled over. What that means here is that the U.S. is in a pretty tricky situation here because what you have is interest rates that are elevated and debt that needs to be renewed. Unfortunately, they didn't take out longer term bonds when rates were very, very low. And so they have to pay this. And that's why you can see that big spike here. Now, when it comes to this big, beautiful bill, which we termed sort of a big, beautiful burden on the next slide, it's really not going to help the debt situation. The slide after this one. It's really not going to help the U.S. debt situation because the interest on the debt does continue to rise. And I mean, everybody's been talking about this for you could say decades about the unsustainable U.S. debt situation. But right now, we have a situation where because interest payments are biting into it, we're going to have to see an increase in GDP in order for the U.S. government to be able to pay this back. And the fact that we're seeing long end interest rates rise really suggests that the market is throwing some water on the possibility of that happening. We did have Black Hole Economics coming into play. So when Ross gets back on the call, he can talk about the implications of this. But we just wanted to sort of outline this. That's it for me this week.
Okay, well, let's go to start off with the index charts. First of all, and nothing particular. I think we're sort of betwixt and between the two break points. So we've had a nice rebound on the Standard & Poor's 500, nice rebound off what we call it super growth price. That's 3.5 times book. Hasn't reached the peak, which the top one, which is 4.5 times book, and that was the peak in 2000 as well. So it's betwixt and between, and the question is now what? Anyway, next slide is the Nasdaq, and same thing. They both had a nice rise, a little bit of a setback recently. Okay, next slide is the TSX composite, and there I keep reminding people that dotted blue line there, that's the fair market value of the index. It's got a long way to go, whereas if we had gone taken a look at the other two indices, we would have seen that the fair market value was below where the current valuations are right now. So I think our general view that Canada remains a better place to invest. I think we will continue on with that theme. And I think in a long-term sense, we are probably going to be shifting from the emphasis on the U.S. to an emphasis on Canada, and that indeed has been a very, very, very long-term theme of our two markets as we have shifted back and forth. Now, down a little bit further, if you could go down a few slides. I'll keep on going. Let's talk about bank earnings for just a moment before I go to the slide that I wanted to talk about. We've had 3 bank earnings now. TD led off the way, did better than people were. The U.S., needless to say, was quite soft. Canada was fairly firm, and the net result, their numbers were just off a little bit. So that was a fairly, I think, a positive report. The Scotia came in next, and their report was nothing to write home about. Their international business doing quite well, and the domestic business fairly weak. Both of those banks came in with down earnings year over year. The third bank to come in was the Bank of Montreal, and they came in with quite good numbers, beating expectations. And I think looking ahead, we have to say that it's kind of steady as she goes. I always want to remind investors, however, that in recessions, we always get our primarily because people can't see into bank balance sheets and they don't know, therefore, if there's any problems or not. And as a consequence, no matter how carefully, how well fortified our Canadian bank balance sheets are, and they are quite, nonetheless, investors sell them willy-nilly anyway. So I always like to buy the cheaper banks so that we limit our downside risk. But then over a long period of time, as I have said before, there very definitely is a kind of a circular motion in the among Canada's 6 banks, with the expensive tailing off and the cheap picking up, and that cycle has gone on for as long as I've been following banks, which is nearly 50 years, I guess, now at this point. So it's a very reliable cycle. Okay, now the last thing I wanted to talk about was go down a few slides. I'm looking for going a little bit further, one further, I think, than that. One up, one down. Okay, no, never mind. Sorry, go back. I'm looking for, there we are, there's a separate there, purchasing power parity, a slide here. This is an interesting slide here because if we go back to Ronald Reagan's time in 1980 when he came in, we see a really interesting picture here of the US dollar vis-a-vis the Canadian dollar. That is the purchasing power parity picture here. And you see cyclically that the US dollar tends to trade off, and when it trades off quite a long way. I remember being quite active in advising a mutual fund in from 2000 to 2008-9, and fundamentally what we did was, we owned U.S. stocks. We simply hedged them, the currency hedged them, and we made as much of the currency hedge as anything else. Anyway, we're at the top of that band once again, and the question is now what's going to happen. Certainly, I don't think it's going to go soaring away. My own suspicion is that probably in the next 5, 6, 7, 8 years, we're going to see a drift as we saw the previous 2 times in 1982 and 2000. We're probably going to see a drift lower in the purchasing power parity of the U.S. dollar, and a strengthening of the Canadian currency vis-a-vis the U.S. And that will probably then underscore that long-term cyclical trade-off that I mentioned between the Canadian market and the U.S. market, whereby the Canadian market wins for a while, the U.S. market wins for a while, and so on. Well, the U.S. market has won since 2008, 2008-9. my suspicion would be that we're getting ready for a switch back to Canada, but it will be long and slow. So that's all I want to say today, but I hope that that'll give us all something to think about when we're wondering where we ought to be, Canada or the US. So that's it, Ken, for me. Thank you.
Awesome. Thanks, Ross.
Perfect. So I just wanted to give an update on the Georgian Partners Growth Fund update. They held their AGM a week ago today, and with regards to their positioning, they're going to be one of Canada's sort of main AI-centric investors. So they are basically at a position where in the first quarter of 25, there was no real investment activity, which really speaks to new investments. And what they said was that the continuation of several of the software trends and themes they saw late in 24 are transitioning into the current year. From an IPO perspective, I think the messaging was that you're starting to see a little bit of a thawing or a loosening. There were some initial public offerings on the part of Service Titan, CoreWeave, and SailPoint that were a little bit more noteworthy to the markets. And those were all NASDAQ listed companies. Generally, M&A activity, particularly in the AI area, seems to be unlocking a little bit of value for investors. I don't know that there was anything specifically related to, Trump and tariffs as to derailing that. But without a doubt, the hottest quote subsector within AI right now, or at least for the last 6 to 12 months, has been cybersecurity. And so, just as putting it in context, Georgian's approach to AI is really kind of three-pronged. There's cybersecurity, there's immersive interfaces, and there's customer experience technologies. And depending on sort of where in the economic cycle you lie, those various companies will outperform or underperform. For what it's worth, Georgian today tends to see their portfolio of companies as falling rather into three different sort of piles. That would be potential market leaders, which is again mainly at this juncture cybersecurity. Companies that had challenges in 21 and 22, so kind of after COVID, and had to cut fixed costs pretty hard, but now appear to be reaccelerating their growth in terms of EBITDA and adjusted EBITDA in the short term. And as a result, those ones are the ones that they're sort of really focusing on dusting off for an exit in the short term. The the DPI, or what we call in the alt space, distributions to paid in capital, i.e. realizations. So kind of when you look at when you're a private equity investor, it's really simple. You got the money you put in, the money you've got back, and the money that you have yet to get back. And as long as those two second variables are more than the first one, you're up, and it's pretty much as simple as that. But the DPI scores for most of the private markets are down, and certainly that is the case with the sort of earlier VC part of the equation. So it's kind of not surprising that you're seeing this. And I know there was sort of a lot of let's call it media coverage about Georgian Partners. Having dove into their latest update, I'm not entirely sure that all of it is necessarily warranted, but for what it's worth, here's where they're at. So talking about deployment and liquidity, there really wasn't much in the way of deployment in Fund 2. There were some secondary market share purchases in Coder as well as YDC. Coder is an AI company based in France that essentially helps recruiting. So it helps employers make better hiring decisions. On the other hand, YDC is a company that's mainly kind of headquartered in Pennsylvania. They have an office in Toronto, as well as two others in Mumbai and Turkey. And that company uses AI and machine learning to help clients, I think more broadly, map out their digital strategy in general, and then potentially sub it off to experts in individual industries. Among the industries that they cater to would be, ag, banking, education, energy, kind of the big ones, and then a more detailed dive into what the actual strategy is falls out of that. So this is Coder's page. You can check it out. And then this is YDC. So sort of again, overall strategy on the part of digital for companies. Liquidity. So this is, I think I the single most important thing they talked about, and deployment, returns, all that stuff is great. But I think, all of us know if you don't got liquidity, you don't got much. And, there have been some challenges here. There is sort of a growing, debate on Bay Street as to whether, some of these groups, it's not just Georgian, kind of, quote, missed a window of opportunity to cash out of some of these portfolio companies, and maybe got a little bit too cute with their, investment programs. Taking a look at the updated numbers, I'm not, again, entirely sure that that's the full story here. But a specific example that's going on right now is the negotiations to sell a portion of Island on the secondary market. So it's really an issue of, it's just like having maybe not a house in Toronto, but let's say a cottage in Muskoka, right? It's less liquid, it's more specialized. Not everybody likes cottaging, and cottages can, be susceptible to that boom bust cycle where, just after COVID, if you'll recall, cottages got super hot because people just didn't want to be in the city. And if you had one, the book, the market value of that on your financial statements went way up. And so they're having to really balance the companies that are like, it's a tale of the haves and the have-nots. And I think that, with the have-nots, they're sort of relegating these things to cheap secondary market transactions. The market leaders, they're kind of, hanging on to it. And so this is just the press release from about a month and a half ago on Island. You can check that out. They're down in Dallas, Texas, by the way. As far as the portfolio companies go, there's 7, and so they are spread kind of equally across, again, customer experience, fintech, education tech. MarTech is marketplace technology and essentially marketing and that sort of thing, and then certainly cybersecurity. And, whereas I mentioned earlier, there's been a lot said about Georgian Partners and other groups. I think they've done a very good job in the sense of allocating sort of larger tickets to some of the more successful stories. It's not perfect, but just sort of, diving into the portfolio companies a little bit more. If you look at Telium and Bluecore, the volatility that we've seen in the markets over the last little while has sort of materially chewed away at their sales and marketing comps, which fell by about 20% over the quarter. Telium in particular kind of experienced, an elongation of their sales cycles with respect to some of their retail customers, and that's not really the best thing to have. And with any business, you kind of want customers to make a fairly definitive decision faster. That's obviously better. One way or the other, it's not good to get kind of too lengthy in your sales cycles because it could indicate a problem. But the EBITDA numbers did exceed management's expectations. Now, just to be clear, this would be the company Telium's own CEO's expectations, not necessarily Georgian's, which is sort of a different management group that we'd be talking about. But the company secured some upsells and progress there. The AR squared did fall, but it's 1% decline on a quarter basis, so we kind of call that a flattish, but has grown on a year-over-year basis. And so they're doing a lot of the right things. We just want to make sure that this sales cycle doesn't get too long. And the adjusted EBITDA, again, very, very nice growth compared to the year ago period, but not really great compared to the previous quarter. So that's sort of an update there. With Bluecore, they did experience these headwinds driven by sort of an overall decline in market comps for the quarter. That company's management team has reduced the 26 full year forecast. And there are some sort of things that they're doing internally on the operating cost side to focus on really stabilizing the business. That's essentially what it is. And they have had some significant churn issues here over the past several months. And that's really related to the company's trajectory or strategy around Allbuy. And that is a platform that it acquired late last year. So, to summarize the fiscal year 25 report, $63 million of revenues. That was below budgeted. They were kind of hoping they could hit at least 70. So again, not all portfolio companies are created equal. With Top Hat and eSentire, Top Hat continues to focus on increasing its digital business while essentially remaining cash flow break even. This past quarter, I think they did a good job of growing its digital revenues and improving its EBITDA margins on a quarter-over-quarter basis. Remember, that was not to be said with Bluecore and some of the other portfolio companies in the mix. And then eSentire launched Investigator, which is a multi-agent workflow app that really enhances cybersecurity investigations through a lot of these AI methodologies. And that's just sort of a jumbled up way of saying in the world of cybersecurity and tech, speed is absolutely your friend. Like there's no question around it. It's like a sports car. You're either fast and exciting or no one cares. And the company had a strong quarter with a pretty good increase in new bookings, as well as on a year-over-year basis. And so you're going to see revenues and EBITDA margins up in the low double digits there. And then on a quarter-over-quarter comparative basis, let's call it flat, which is in light of what's been going on, not bad. And then just sort of finishing off with FreshBooks, the big sort of, I guess, news story out of that company was the appointment of Shaheen Javed as the CEO in January. The company also secured a $125 million debt facility from a new lender. They didn't really get into the terms and conditions there. It's a big number, which sort of is one way of looking at it, but it is a new lender. And so the question is, are the terms kind of radically different from their previous debt facility? Sometimes when you see that, you kind of, as a manager, your first question is what happened there. A new CEO is great, but $125 million loan is probably more homework needs to be done there. So that's sort of an overview of Georgian Partners. They are big into AI. And just to summarize, again, if you're going to be in AI, for heaven's sake, be in the areas that, industries need to have versus stuff that's kind of, nice to have and kicking around. Okay, charts of the week. I'll try to blast through this really quickly because, Ken Ross Gilbert and the rest of the team kind of commented on stuff generally. Maybe I'll just sort of get right into the charts, because they really do tell the picture here. So good, nice, rebound from that first and second week of April, and then kind of in the near term overbought. And you could see that where it didn't even crash into that way up top high, third standard deviation line of the 50-day moving average. But it came down through the second standard deviation moving average at the top end, and then actually bounced up again. So I think the interpretation there is, um, you know, maybe the whole market is sort of getting tired of kind of daily coverage of the trade war, and is focusing on other things like this 1 cent dividend that Nvidia put out last night, or other matters. And I think that's kind of healthy. Looking at the markets here, you can see it for yourself. Good rebound from call it 4 or 5 weeks ago. And that's sort of nice. Small caps still sort of a question mark. Dave and I were just sort of speaking about that offline, so we'll have to kind of understand what's going on in the world of the Russell 2000. Volatility materially lower from sort of the market malaise several weeks back now, and what you're seeing is fairly good standing on the part of the NYSE advanced decline line, the 50-day moving average, but also some of the more risk-on metrics, such as the Nasdaq versus utilities, or even semiconductors versus the S&P 500. So there's that. From a relative sector perspective, very little in the way of jockeying for positions technically amongst the various S&P sectors. These were all ones, which is not material or noteworthy. So we'll just take a quick pass on that. Andrew, I think, likes to look at the markets as, not, he's definitely not in that let's be too cute with buying dips, or, exactly nailing the timing. He does love corroborative evidence. And so he's not looking to buy the S&P 500 down at that danger zone, because, I think Ross sometimes talks about this. Usually stuff that's cheap is cheap for a reason. And so you want to buy in that ideal buying zone. And also there's this sort of minimum dip range that he points out. This is actually a really good chart. I've not seen him use these boxes before. And if you're kind of a visual person, it's really helpful to see these sort of, and it's like a traffic light, like the green, red, and yellow. So I do identify with that. So that's pretty cool. Looking longer term, this is a longer term analysis, technically, of the S&P 500. And there's a couple of things here. First, the longer term track record with this upper red trend line is not the best, unless you're skilled at buying put options or going short. The market has a tremendously tough time getting through this upper end of this channel, and that would appear to be happening once again with respect to that lower panel, the relative strength. And so it just seems as though the market needs a lot of oomph and torque to get through that upper range, and it rarely happens. And when it does, it's just sort of a blip, not a sustainable move higher. So what he's getting at is that looking more widely, we're at a point in the markets where potentially a lot of the recovery from late March and early April has been baked in, and maybe we settle into sort of a sideways pattern across the rest of the summer. And then this is just another chart of the Sprott Physical Uranium Trust. We hold this in various investment portfolios depending on the mandate, and so we do like this area sort of generally. it did peak out in the start of 24, and it's been most of 24 coming down. But it has since staged a pretty good recovery. And I think that if you really zoom in on where that very tiny red arrow is, the downward pointing red arrow on the right-hand side of the chart, it did cross through that overhead red line. The issue is again, how much conviction is there in that? Like, did it just kind of blip and then come down, or again, it's more the sustainability. But for what it's worth, technically, Andrew does like uranium, and so do we. And then finishing off with Japan, we don't always talk about Japan, but this is the EWJ. So this is the iShares MSCI Japan. It did break up to new all-time highs this past week. When he says this past week, he means last week. These reports come out kind of late Tuesday, early Wednesday, and that's notable in the kind of global market that we have had. In addition, that potentially sets up the stage for Japanese equities to move higher. We've had a discussion with a group out of India not too long ago, so it's nice that we're sort of looking again outside of our own four walls of our cubicles here in Toronto or even Southern Ontario, into global markets. And I think that he's good in pointing out here that he thinks it's worth kind of keeping Japanese equity, so the Nikkei, in the back of your mind, as long as EWJ remains above, call it, let's say $70, for what it's worth. And below that, he would be concerned that maybe this was just sort of a blip and not necessarily a sustainable upward kind of secular move in Japanese equities. But that's it for myself. Thank you. And Chris Curry, I think I see you on the call. Good morning. I don't see you, but we see the CC.
Good morning, I'm
so,
here.
Yeah,
And,
yeah. How are you?
Right, can you hear me okay? I'm here. I'm good. How are you?
Yeah, good, loud and clear. What's going on in
Fantastic.
the wonderful world of fixed income?
Yeah, well, a couple of things. Um, let's start off with the U.S. and U.S. bond market, and I think that the general consensus is moving towards it's always been like no recession in the U.S. I think is pretty much been the predominant view, but as Gilbert mentioned, I think higher growth expectations, especially from the big bad bill, which is still fairly high octane stimulus, is going to push growth higher, and the bond market's reacting to that. The I did want to comment on, I think Gilbert had a discussion on bills, bonds, and it struck me that it's the same situation, but between Janet Yellen and Scott Bessent, and but they arrived there from different places. So Janet Yellen sort of took the easy way out and went for the lowest, tried to reduce the debt, the interest burden percentage of GDP, as Gilbert showed, by issuing just massive amounts of bills at almost zero rate. And she's been sort of widely criticized for that strategy. Scott Bessent in the Treasury is moving in the same direction, but they're getting there through a different situation, in that the bond, air quotes, bond vigilantes are putting a lot of pressure on the U.S. to ease off on issuing 30-year bonds, because that's going to really explode rates higher and send a lot of bad signals that could really unsettle fixed income and could unsettle the interest rate markets. And we're seeing pretty much the same situation in Japan. They're getting a lot of pressure to ease off their 30-year issuance. So that's sort of the similar scenario, more bills, but different paths to get there. And shifting back to Canada, Ross mentioned an interesting point about how banks get hammered in a recession. I still think Canada is either in or is going to be in a recession. The problem with Canada is our statistical reporting is so lagged. I mean, we have to wait till June to get our Q1 GDP numbers. So, we're really sort of behind the wall of invisibility there as to what's really going on in the economy. But I take a couple of anecdotal inferences. The first one being Carney not producing a spring budget. I mean, if the former governor of the Bank of Canada, Bank of England can't produce a budget, I mean, there's got to be something behind that. So that's sort of classic liberals will just withhold the information, and but I don't think it's good. So my prediction would be Q2 or Q3. We're going to be in an official recession in Canada. We see unemployment. It's getting close to 7% in Canada, which is really, really extreme. But we do have the drag along from the US, which could be entering quite a period of stimulus. So and that may save Canada, but there's the tariffs to consider on that point. And then lastly, just on the market's view of interest rates, still 2 cuts in the US, 1 cut forecast in Canada, but the US cuts have been pushed out to Q4 in October and December. So and the cut in Canada is now market's saying in September. But Canada just doesn't have much room to cut. I mean, rates are so much lower in Canada. There's really nothing there. So I guess on that note, I'll turn it back to you, Joe.
Okay, great. Thanks, Chris. Always, the triple B, the big beautiful bill and big beautiful bond yields. So that's exciting. It is exciting that we're talking about the treasuries and fixed income space more. I can't quite see from my monitor if there's anybody else on the call that'd like to contribute. Paul. Oh, PB, there he is. Hey, Paul,
Yeah.
how are you?
Hey, Joe. I'm very well. Good to hear you guys' voices. Thanks for the update. Well, I would just like to. I have basically 2 observations. The only thing we know now, that's just for sure, like in this very unpredictable world, what is for sure? The only thing we're convinced of is that all our Western governments are now committed to, reckless spending, right? So Trump, I guess that the first 100 days, there's talk of Doge and maybe reining in some the budgets and maybe finding $1 trillion of value and all that. It's all gone now. This has been thrown out the window, because even if he finds a 800 billion to save, he's going to go spend another 2 trillion somewhere else. So we're running record deficits now in the U.S. and Trump's not going to stop, right? There's no sign of him stopping. If anything, it's probably going, with his tax cuts and whatnot, the deficit's going higher. Germany has announced they're forecasting 7 years now of stimulus and deficits. Canada's been running deficits forever. They're, the economy is going to get tougher here. So there's no sign of Canada getting its act together. And frankly, the Japanese aren't changing their 25-year policy of running deficits. So every Western government is spending more money than they have. And so what does all of this means? It means currencies are going, fiat currencies are going to continue to be debased, right? I mean, the governments probably even want it to happen, right? They want the U.S. dollar. The Americans want the U.S. dollar lower. The Canadians want their dollar lower. Everybody, it's just it's the same problem in the Western world. So what do? You really only have one play, and that's to own hard assets. The more hard assets you own, the better you're protected. And so it's just so abundantly clear. So I think gold, I think silver, is going to be spectacular. We're going to have a breakout. It's just on the cusp of breaking out here. When it goes, it could easily, do a radical move, a doubling of value. And so, it means the same for energy, I think, in general. And you can get into all those rare earth metals, any hard assets. And I just don't think you can have enough of this stuff in your portfolio. And then we've even, after studying the crypto world for the last 6-7 years, and we're no experts in this, but we still don't understand why you need 5,000 different, cryptocurrencies. It's just insane. So that, there's a bubble there for sure, and someday it's going to crash. But the truth is, Bitcoin, Fidelity has come out, JP Morgan has come out, and of course Trump's pro crypto. So they're all saying you need to have some form of crypto. And I guess we've come to the conclusion that is almost like a guarantee that everybody should have some. Everybody should have some Bitcoin. Because the only thing we know is there's limited supply, and it's going mainstream, right? It's going mainstream America for sure. And so you're going to have the pension funds buy. Fidelity is recommending 2 to 3%. JP Morgan the same, all this stuff. So we've gone in our fund to 2-3. We're at 3% Bitcoin. It's a simple thing to do. Put some, buy one of these ETFs, put it away, and don't look at it. And it's right at the cusp of breaking out as well, right? 110,000 is a new high. So I don't know. I think we've been converted, and do we see 150 by Christmas? 200 next year, for sure. For sure, yes. Nothing, of course, is for sure. But the trend is there, and that's got some serious ramifications for all sorts of companies, right? So I think you're going to see, not only the pension funds buy crypto, but you're going to see the corporates start to buy. And when Google announces that they're, putting 5% of their cash into crypto, and Apple does the same thing, and Meta, then, the momentum's just going to be there. So greater demand, fixed supply, prices go up. So those are our sort of no-brainer observations now. And so you can make a lot of money. Why would you, people say, I'm going to go to cash. I'm going to go to, 20% cash. Well, just tell me which cash you like. So which one do you want? You want to own cash so badly? Okay, which one? Whereas you can jump into gold, silver, and Bitcoin just as easily, and it's not cash, but it's I think it's superior, right? It's better. So and that's it for me.
Yeah, that's great, Paul. Really timely, because we had a couple of investor calls, and a lot of people are asking us about cryptos. And the bottom 10,000 of these are just outright scams. But I think if you're into Bitcoin, Ether, Ripple, Solana, and Cardano, you're probably going to do okay, because those are the ones that are going to be included in that crypto strategic reserve that Trump talked about in March. But I like the way you talked about, Tim Cook and Bezos and some of these other, top bananas putting their corporate monies into that. That's really going to move it. And then if you got, some of the pension schemes, right? Ontario Teachers, CalPERS, all these other groups, that's a pile of money that could move into this. So it's exciting for sure. Okay, great. And anybody else have anything to contribute today?
Nope.
Going once, going twice. All right. Well, have a great rest of May.
Awesome.
Take care, guys.